Resurgent India Limited is registered with SEBI as a Category 1 merchant banker. This webinar is for general information purposes only. Views expressed are not intended as investment advice or CB regulated merchant banking services. Welcome to Private Credit, Filling India's Funding Gaps webinar presented by Resurgent India. Your moderator, Ms. Sonal Mehta, Senior Vice President, Resurgent India Limited. On the panel, Mr. Pankaj Sharma, Director and North Head, Care Edge Ratings. Mr. Pratik Tibriwala, Senior Vice President and Head Corporate Finance, M3M India, Pivot Lectiri. Mr. Sandeep R. Khandelwal, CEO and CIO, Arana Capital Services, LLP. Mr. Ankit Jain, Director, Private Credit, Motilal Oswal, Alternate. Our panel for today's session. The session begins shortly. Thank you for joining us.
Hi, good evening, everyone. That's Sonal Mehta from Resurgent India, and I head the business development and strategy for them on Pan India. So I think, it is a pleasure for me to be moderating this session with all my eminent speakers. So before we start with the session, so I would just like to take some time to set a background for this discussion today. So I think, in the past few years, there has always been a funding gap between real estate projects where, the developers have their own query as to the funding is not happening into the projects, या bank पैसा नहीं दे रहा है, or we've not been getting the institutional support right now. Okay, land has been acquired, RERA approval licenses have been in place, but we're still not able to raise that kind of a funding money that we're looking at right now. The bankers have their own challenges where they feel, that probably the project is not that viable or on the credibility of the developers there that they're talking about there. So that is where, I feel the gap which is there is because of the structuring. Because the normal banking system, when you're talking about, be it the PSU banks, the private sector banks, or the NBFCs that you talk on, have certain guidelines where, these guys don't have the kind of products where the proposals can be structured at that stage. So that is where, I think a private credit as a funding gap comes into the picture. And, I think that's a very, very interesting data which I have right now and would like to share here, that India's private credit market is coming up this year, that they have credibly done a lot of work in the past 5, 6 years. And we have emerged as one of Asia Pacific's largest real estate private credit market between 2020 and 2024, and which is like India accounted for 36% of all APAC real estate private credit fundraising, which is, I think, a pretty huge number that we're talking about today. This growth mirrors the broader global expansion of private credit since 2022, as tighter bank lending has increased demand for alternative sources of capital, like we were discussing right now, कि banking में वो probably products नहीं थे, and because of that, the private credit market has emerged right now. And also, alongside the role or the scope for the private credit has also increased. The growth capital, the private credit, new funds, last mile construction, promoters, equity contribution are all covered and can be taken care under this product structure right now. And the last and the most important thing is that post the February 2026 RBI direction, where eligible borrowers can refinance the existing ECB loan wholly or partly through a fresh ECB. I think this will widen up a lot of more options or horizon for the developers to raise further funding or to structure the deals better. I think, with this, I would like to start my discussion with my eminent speakers. First of all, thank you so much, everyone, for joining in. And I don't think, we could have a better panel today with, we have a mix of developers, the fund houses, the rating agency, people coming in together. I think, it's going to be a very interactive discussion to begin with on this. So the flow, I think, we will be taking up questions one by one with each one of you, and then we will keep the question and answer session open for our audience. So in case anybody has any questions, you can probably put it in the chat box, and I will take it up at the end of the session with my eminent speakers. So thank you and welcome everyone to this interesting session. So I would like to start my discussion first with Mr. Pankaj Sharma. So Mr. Pankaj Sharma is the director and North Head for CareEdge Ratings. So Pankaj, with the growing participation from offshore private credit providers, how do you expect market standards around covenant, security, packages, and documentation to evolve?
Yeah. So see, I think this is perhaps one of the most consequential but under discussed topic, and this is one of the
Absolutely.
shift that's happening in India's private credit market right now. See, we are at an inflection point today,
Hmm.
not just in terms of the capital volumes, but also in terms of the market architecture
Hmm.
and the entry of the offshore capital. This looks like one of the single biggest catalyst for that architectural shift that we are discussing. See, as we saw that around 2025 calendar year, if you see, India's private credit market somewhere was around $12 billion. And there was some 160
Absolutely.
odd transactions that happened, and we saw some 35% year-on-year growth in value. Real estate, as you said, was 42% of this total private credit, right?
Hmm.
So this is some institutionalized scale capital. And now with scale, there has to be the demand for global standard documentation, right?
Hmm.
So if you look at the regulatory angle or support over here, especially from RBI and SEBI, so RBI with their FEMA 2026 regulations, I think they try to notify that by they've kind of tried to replace the prescriptive approval-based rules with, you can say, a principle-based regime. So offshore lenders can now provide guarantees for rupee bonds, as you said,
Okay.
without the minimum average maturity constraint, right, which was previously a structural barrier. So this means that the offshore capital is arriving through a properly documented and a legally clean structure. And with
Right.
that comes a very different expectation on the covenants. Second, on the SEBI perspective, the large value fund threshold has now reduced from 70 crores to 25 crores. So the
Hmm.
domestic AIF universe has deepened significantly because of that. So it's
Hmm.
creating more domestic lenders who are also demanding sharper documentation standards because they have to compete and complement the offshore players here.
Hmm.
So now, in terms of discussing what typically changes for covenants, security, and documentation, one, the financial maintenance covenants are tightening. Your LTV thresholds, the debt service coverage ratios, the sales
Hmm.
velocity linked tests, all these are becoming standard in real estate transactions. So they are not any optional add-ons now, right? Offshore lenders, I think they are trying to import the covenant frameworks from global markets, and I think Indian borrowers, particularly the ones, those who want to seek repeat access to institutional capitals, they're adapting to it, right? That's on
Hmm.
the financial covenant. Second, on the escrow architecture, I think that's becoming more deeper and more enforceable now. So
Hmm.
in domestic private credit tradition, see, the escrow arrangements did exist earlier as well, but they were oftenly, what you can say, loosely monitored, if
Hmm.
I can use that word. The emerging standard now is that there is a full revenue waterfall mechanism which is there. You will have your stat dues, you will then have your operating expenses, your
Hmm.
interest, your principal, and then the residual goes to the promoter, right? So
True.
the investor's obligation is serviced before the promoter even sees a penny or a rupee today somewhere. Third, I think on the security side, the security packages are layered now. So we
Hmm.
are moving from a promoter guarantee, which used to be the primary comfort to
To
towards
institution.
the
Right.
securities, right? Now you have multiple layers. You will have your charge on the land. You will have hypothecation of the receivables. We have seen
Hmm.
the pledge of SPV shares, and in some of the cases, we have seen that there has been a debenture trustee controlled escrow, which also has
Hmm.
step-in rights, right? In
Hmm.
I think Shapurji Palanjo transaction, we have seen how kind of that turned out. So SEBI has also been actively monitoring these debenture trustees to ensure that the covenant testing is undertaken effectively,
Hmm.
right? And then there is the fourth, smaller but growing covenant, which is the ESG linked covenants. Since we're
Hmm.
talking about the private credit capital over here, the offshore capital, which typically or primarily comes from European or multilateral sources, I think they are kind of increasingly incorporating sustainability conditions over there. So,
Right.
right, we have seen that the recent documentation trends in Indian lending, they have
Hmm.
this ESG link covenants, the disclosure obligations, the green things that you're doing, and the independent verification requirements which are there typically, right? And real estate, it typically accounts for around 40% of the global energy related CO2 emissions, right?
Hmm.
So it's not just a novelty, right? These are
Hmm.
structural requirements to access the best offshore capital price if you want to, right?
Hmm.
So I think in a nutshell, if you look at, I think the two lines I would want to end this question with is the market that will resist this standardization will find its cost of capital rising, and the
Hmm.
market typically that will embrace it, it will find a new pool of investors opening up for them, and I think that is ultimately good for our India's real estate sector.
Absolutely. I think, Pankaj very well covered on all the 4 points when we're talking about that, the offshore capital which is coming in, which is better structured now. And then a lot of new AIFs in the domestic market coming up, which is giving a good competition to the offshore guys which are coming in. Better escrow management that we're talking about. And yes, the security angle also, which you covered on. Now it's not only promoter or the land, which is a security. There are other securities which are to be managed and taken care. My only one thing here is that ESG, when we're talking about, is one of the primary or one of the important criteria for a offshore capital. What are your thoughts on the new AIF funds which are coming up in the domestic market? Are these guys also putting it as one of the criteria for funding the projects in to the developers
No, I
in the
think
domestic AIF?
it's at a very nascent stage for them because somewhere I think the European funds majorly they have put it
Hmm.
because it's been one of the key governing parameters for them, right? All across, right? The ones which are
Right.
domestically coming up, because in India you would see, I think we as credit rating agency we started doing ESG rating some time back, but even
Hmm.
that is not mandatory today, right? So
Hmm.
till you will have a regulatory mandation towards all those
Hmm.
kind of things, the enforceability becomes slightly slower. So I think this is one of the areas wherein some bit of regulatory stepping needs to come in, and
Absolutely.
that is where I think this will then start creating some differential values even for the domestic AIFs. As of now, I think it is at a very nascent stage for them. Not much differential.
Because when I did not know much about the ESG from the
Hmm.
offshore side. So
Hmm.
when you mentioned about that, I was just thinking about that. I think then there has to be some regulatory thing. Even the domestic AIF guys can come in, so that will help in improving the quality of the projects more,
Correct.
and the developments which are happening. So I think that will also value add, and plus it could be a good parameters for them even to filter out developers whom to work with.
Correct.
Great. So thank you so much. I'll come back to you for your next question. So my next question here too is Mr. Prateek Tibriwalji. So Prateek ji is a senior vice president, head corporate finance with M3M India Limited. So Prateek ji, private credit transactions have transcended from being solely special situation or distress as a driven financing to being a more broad-based fundraising avenue for corporates. Are you seeing developers return to the same lenders across multiple projects or financing cycle? Um, पहले अगर हम देखें तो जनरली लोग प्राइवेट क्रेडिट में जाते थे कि जी लैंड खरीदना है तो
Yeah.
उसमें डेवलपर तो नॉर्मल इंस्टीट्यूशन को पैसा देगी नहीं जी ठीक है सो दैट टाइम वी आर लुकिंग एट अ प्राइवेट क्रेडिट एज एन ऑप्शन टू कम इन but now there are a lot of other structures where people have been exploring private credit as an option. So how do you think this is developing right now, and are you seeing developers returning to the same lenders across multiple projects or financing cycles?
No, absolutely. I think what has happened, if you look at the entire fundraising market over the last decade, what's changed is now we have very less opportunistic pool of capital which is available globally as well as domestically. Now what you have is more thematic capital which is available. So it could be a capital for office yield fund, it could be for warehousing, it could be for retail, it could be a pure real estate, lending based fund, or it could be a private credit fund which is sector agnostic, and real estate could be part of the portfolio. So
Right.
with different pools of capital, what's coming is also the entire all these organizations wants to now do platform deals, because they have created pools of capital which are special.
True.
So the LPs who might be investing in a real estate lending fund could be very different from LP who might be investing in office yield fund. So the teams who are underwriting this, the investors, and the kind of partners whom they want to partner to deploy this capital is also changing. And now everybody wants speed, certainty, and both, whether it's the investors or the developers, all of them want certainty to a transaction, because
Hmm.
the cycle has become longer. So
Hmm.
what's changed in last 10 years is, when you were dealing with HFCs, housing finance, or NBFCs, typically you could end up doing a trade in 30 to 60 days. Now, the
Hmm.
moment you are now dealing in the private credit space, I think the transaction timelines have changed significantly. When you're talking to these global players, or even reasonable sized AIFs, they could be taking anywhere between 60 to 100 days, could be 120 days if the transaction sizes are longer. So
Hmm.
what you need during this time, and then you have a lot of turbulence which is happening globally. So you have some global events, you have some domestic events. So intentionally what is happening is, you tend to create platforms where there is more certainty of capital, there is a longer duration of partnership, and you want to create volume and value. So it is moving away from a single transaction led approach to a more
Platform deals.
platform deals. And the relationships also now take a lot longer to stitch, because this is
Hmm.
now no longer a single asset based transaction. So the meeting of the minds at the leadership level, the entire corporate governance, your execution track record, your ability to stand by and deliver during testing times, your cash flow, everything matters. Your quality of delivery, your ESG, how are you moving ahead with the market. So a lot of these things have changed. So this essentially has led that, yes, there are a lot many investors out in the market, but every investor is operating in their own niche. Every developer is working with few set of investors whom they're very comfortable, they're very keen to work with the others. But at the end of the day, everyone has figured out a niche. So everybody tends to do a lot more repeat transaction, because the credibility helps both on the investor side as well as the
And
developer
the
side. You're
developer side. Right.
always willing to walk a mile with your trusted partner, because one thing which is very clear is, when you're investing in large long duration projects, 7 years, 5 years, 10 years, you will have the ups and downs. You will have the economy or the global economy going through its turn. What you need is a more trusted partner, both as a developer as well as the investor. So I think uh, there is no doubt in my mind that we have moved away from a transaction led approach to a more partnership based approach.
Absolutely. I think, I completely agree on that, that earlier the funding used to be transaction based. ठीक है जी, ये रियल एस्टेट का प्रोजेक्ट बनाना है, लैंड खरीद लिया, अप्रूवल आ गया, ये कंस्ट्रक्शन है, ये कैश फ्लो है, इससे रीपेमेंट हो गई, थैंक यू सो मच, डन.
Yeah.
But now when we're talking about platform deals, as such, which you rightly said, where he has multiple exposure into the projects in the group, so there he is coming more as a partner rather
Yeah.
than just a investor kind. Then he is more of a partner to you in the group for all your projects right now. And that is where these guys actually do a lot of due diligence, credibility, and that's the whole purpose, that the time frames have also increased. And yes, the repeated developer investor relationship is also the same way कि आप एक बार एक transaction अगर कर चुके हो तो आपको वो comfort आ जाता है. I've done work, done the due diligence part of
Yeah.
it, so that you are comfortable with those guys. And since it's a large ticket size transactions, a longer duration time to close a transaction, so that's why also these guys are also very skeptical about going to a new developer or spending time doing the due diligence part of it. But I think, that's the way the market has also been evolving, and a lot of large deals have been happening at the platform levels there, which was very rare, I would say, 3-4 years back when you're talking about. One, nobody had that appetite to do that larger transaction at a platform level. And two, the risk also people were not very comfortable taking. ठीक है, 2,000 crore रुपया एक group के अंदर कौन डालेगा? So that way, generally, people were very risk apprehensive at that point of time. But I think that's a right way of approaching the market right now, that once you are doing a platform deal, it's more of a partnership than just an investor-investor kind of a relationship. Great. Thank you so much, Prateek ji. I'll come back to you for your next question. My next question is to Sandeep ji. So, Sandeep, why has the private credit become more relevant to real estate than almost any other sector? I think, you'll be the best person to answer this, because, you have been working with a developer also, and then, setting up your own AIF now. So, how do you think this is more relevant to a real estate than almost any other sector?
Hi, Sonal. See, the basics all of us are completely aware of. So we do understand that in India, banks are very, averse to financing real estate per se, not as such for infrastructure. Infra is financed properly. It gets the correct ratings. It gets the correct, ROIs as well. But then for real estate, it has not been so. The banks have always preferred, very strong cash flows, very strong balance sheets, legacy names. They always prefer, very low LTVs. They want to take the least risk possible. They want to come in, when half the project is over, for the last part of the last part of the financing. Whereas private credit has solved all these problems, and because private credit understands that the developer needs are absolutely different. Developer does not need capital very, like in the scheme of things. The most important chunk of capital is not required for construction after half the project is done.
After the RERA approval,
Yes, yes.
you're almost sorted.
Then the project is, if it is a residential project, majorly, it is funded through customers themselves, right? Through their EMIs, basically. So the developer calls for the stage-wise payouts, and the bank honors the payouts. So that is not the money that developer that really requires. What a developer really requires money for is to get the land. Either land is bought on an outright basis. Land is never financed by banks. Either it's a joint venture, and if it's a joint venture or a joint development, there could be a large, upfront payout to the landowner, which the developer has to honor. It could run into, a good significant amount for a good patch of land. So even if it's not an outright purchase, JD requires a good, hefty, down payment for the developer to begin any kind of approval process. Then comes the approvals. Now, approvals require a major chunk of money, and we all understand, or we all know, India is not, again, a very easy place to receive developer approvals or development approvals, whether be residential, commercial, or whatever. Even for warehousing, we take around 6 to 7 months. And so that's not a very investor-friendly market. Again, banks cannot finance these cycles. Except for this, majorly where developers get stuck. Everybody knows that. Again, so let's talk about our market, precisely the Indian market. We have seen the ups and downs of the northern Indian real estate market in the past couple of decades. All of our drawings, in fact, RERA was structured after the NCR market collapse. That was the stage which set for a body like RERA to be created. Now we are a little euphoric with regards to usage of funds. And if you leave Indian developers to self-regulate themselves, you will see a repeat of what happened earlier. So the regulations definitely helped a lot to infuse confidence in private investors, in private investors, private credit givers also. So NBFCs used to play a very large part, right, as a alternative to bank financing earlier. But then after the failures of ILFS and the stress at DHFL and such other NBFC scenarios, private credit also became more important after NBFCs pulled back a little from the quantum that they were financing real estate as a sector. So private investors gained confidence because banks were not doing it. NBFCs pulled out, and RERA came in to give them, the right kind of confidence when it was required. So these three things played a lot of role. After that, what I really see is key in terms of private credit as a product. What it really entails is, so all the investors in, say for example, a credit AIF or an equity focused AIF are generally similar, or most of the time same families, same individuals, same family offices, same institutions who are allocating to equity as well as credit, right?
Right.
Credit is attractive because it is, of course, asset backed, and real estate is the most asset backed because the product is the asset. And if it is a good project at a correct location being developed by, say, not not a category A plus plus developer, but even a category A
But
developer, yeah,
B
with
category as well.
just a category A developer or category B plus plus developer with a great location, then the cash flows are very, very visible. Plus, the asset is completely secured. Generally, in real estate right now, all the domestic funds, or all domestic funds, I'm talking about majorly domestic funds, because residential, if you talk about exposure, domestic funds are taking more exposure to residential as of now, whereas a lot of external money is going into warehousing and hospitality now, also coming up for hospitals. These sectors are not covered by domestic investors or domestic AIFs as of now. So real estate, I think, offers the best collateral and the best visible source of cash flows. After that, it's from the developer's end. The most important thing is developers also prefer debt more than equity, because equity, of course, takes away ownership, takes away control. You have to give both seats to external observers. And the most important thing is the opportunistic upside is also lost, once you allocate equity to an equity stakeholder or an equity giver. Whereas once you take debt, all the upside, opportunistic upside, is yours. All the board seats are yours. Control is with you. So even developers prefer debt over equity. It lets them be in control of the project, and most importantly, be in control of the opportunistic upside. I think these are the most important reasons why real estate is the most attractive to private credit in India. Yeah.
Absolutely. So I think the crux here would be that we talk about primarily that real estate is the only segment where you can't get the bank money or the institution money when you need the most.
Yes.
That money starts coming in जब आपका सारा खर्चा हो चुका होता है, कि लैंड का खर्चा हो गया, अप्रूवल का खर्चा हो गया, लाइसेंस का खर्चा हो गया, when advance from customers start coming in, that time you come back and say कि हम construction finance कर देते हैं, where
बिल्कुल.
the developers actually don't need the money, because at that point of time the advances are already coming in. Even if
Yes.
these guys are taking money at that point of time, that is probably just to protect themselves from the risk कि ठीक है जी, अगर project में कुछ delay आ गया या advance from customers कभी delay हो गया, so at least we should have some source of capital to
Yes.
keep the project running.
Yeah, at least for the financially judicious developers, what you said is absolutely right. They do not need money, once.
Mostly these guys don't have an option, right? All of them have to be financially judicious there, because there's no other way out these guys can look at right now. So I think you're perfectly right that this is the only segment where they are not getting the money at the right time from the institution that they need the most. And at that point of time, if the private credit or the AIFs as such are coming in as a source of funding, so that's a win-win situation for both the private credit guys as well as for the developers, where at least we can partner and complete the project on a timely basis.
Absolutely. Even for the PC investors, they're able to capture the most upside that is possible by partnering at the land stage. Yeah. So it makes it more attractive.
Yeah. Thank you so much. So my next question is to Ankit ji. So Mr. Ankit Jain is the director private credit with Motilal Oswal Alternatives. So Ankit ji, do you expect India's requirement for non-banking credit to increase meaningfully from here? Which real estate segments are likely to drive the next wave of deployment? Be it residential, commercial, or even office spaces when you're talking about. So what are your thoughts on that?
Right. So look, while the commercial banks continue to dominate the lending landscape in India, uh, the non-bank alternative credit is not just transforming from the last resort funding gap into a mainstream financing ecosystem. India's private credit market today, as very recently reported by Moody's, is close to $25 billion, and they are projecting it to almost double to $50 billion by 20, FY30. So, like what Sandeep was mentioning, a lot is changing from the private credit standpoint, and reasons very rightly identified is that this space initially was captured by NBFCs in the country.
Right.
And once we saw the vacuum in the NBFC space, which is larger players like INFS, Reliance Capital, Shrey, DHFL, some of the very large NBFCs who used to provide corporate lending, they went under. That's the first impact. Then the second impact, which I've seen over the last few years, is that these NBFCs are now focusing on the ones which are operating, are focusing on the retail side of the business. The
Right.
reason why retail sector is attractive is because the public markets like it. You get better valuations.
Mhm.
And when corporates of some of these NBFCs who are trying to list themselves, they are actually doing away with the corporate book. To be honest with you, in the last 2 years, 3 years, I have seen certain NBFCs who have approached us asking us to buy out the entire corporate loan book so that they can focus entirely on the retail side of the business.
Okay.
So, yeah,
That's
so that
yeah.
that massive thing that is happening. I very vividly remember. I'll not take names in the public forum, but I very vividly remember two mid-sized NBFCs telling us that can you just take away our corporate book because we were probably planning for an IPO in a year or two. Because the bigger the retail book is, the better the valuations are, right?
True.
So that's another reason why a vacuum or a space is getting created, and that is why the AIFs and the private credit market is booming and growing. And if you focus on the number of AIFs that have come up, are far too many than what it used to be a couple of years back. And there's enough competition for all of us who are operating in this space because still the deal flows of the deals where you would want to invest money is still the same or limited, but the number of players in the private credit side are quite a few. One more reason I think why this space has become so hot is because of some of the tax-related changes that have taken place.
Okay.
Mutual funds used to operate in the space and had the ability to do play with the capital gain tax rate, which has been done away with. And now there is a level playing field for both AIFs and mutual funds, and that makes the space even more attractive. Uh, Another important aspect why the private credit space is good is because uh, NBFCs and banks used to have SARFAESI rights.
Hmm.
AIFs today don't have SARFAESI rights. But
Okay.
with the advent of IBC, Insolvency and Bankruptcy Code, which was introduced in 2016, even AIFs have IBC rights. So from a security invocation point of view, when you lend money, the most important aspect that you see is whether you will be able to recover your dues in case of a default. The ability of banks and NBFCs back in the day used to be higher, but today nobody cares about SARFAESI. It is
Hmm.
anyways old and I would say with very little teeth to recover money. SARFAESI is probably more applicable for retail loans. Uh, IBC has played a very good role and has more powers and ability to recover money from corporates. And
Okay.
that's why, and because AIFs have the ability to go to a bankruptcy court, go to an NCLT, and take a company to bankruptcy in case of a default, has made this market or strengthened this market for AIFs. So these are the bunch of reasons why AIFs are doing well, and I would say it will continue to grow in the near future.
All right. No, wonderful. I think, pretty interesting to understand. Just one more question on this aspect. We understand that, that probably retail is something which is becoming pretty active these days. But how do you diversify or bifurcate this between tier one, tier two, tier three kind of markets as such? How do you see the markets in tier two, tier three? There, do you think retail again has been booming, or there you have more of residential and plotted which has been coming up?
No, I think tier two and tier three, especially tier two, is actually playing a very good role. For even for private credit players, real estate beyond a point is a micro market situation. Every AIF will look at certain markets which they understand better. People on ground team that you have on these places, and the ability to underwrite a credit in these markets. So it becomes very, but the market is huge. I mean, from an AIF standpoint, generally the way we at least define it is there are two kinds of funds. You have real estate fund and non-real estate fund. So there is enough and room for everyone to take, but it is your ability to understand every micro market and then underwrite the credit in those aspects. But Ray rightly said, tier two is becoming more and more interesting, and people are focusing on tier two. Tier three, I would say, is still going to take time. But tier one is already overcrowded, and tier one has enough competition. So yes, people are trying to move to tier two, which is doing well, and it is definitely growing a lot.
Right. That's what अंकित जी मैं आपको पूछ रही थी tier 2 और tier 3 में भी जब हम बात करते हैं, so there also do you think retail is the flavor, or there the residential or the plotted are more of the flavor?
If you're asking from the perspective of AIFs,
yes,
from private credit funds, I would say private credit funds will continue to play in the space where they fund developers and corporates only. Whether private credit fund, so let me put it this way, private credit funds are also funding NBFCs who onward do retail lending. So
retail
AIFs might not be able to do retail lending, which might not happen because these are small ticket deals which you can't do without having a branch or a network, which only banks and NBFCs can do. What an AIF can do is they will always fund an NBFC or a developer directly. The retail lending will take place onwards. It probably won't happen from an AIF's book.
Okay, great. Oh, interesting. So I think, that is where the gap needs to be covered, because there are a lot of funding which is already happening in the tier one. And yes, there are certain movements in the tier two side also. And it'll be interesting to understand more, how the tier two and the tier three market is getting captured for the developers, because there are a lot of good developers who are trying to enter that market. Not being able to, because sometimes they feel कि वहाँ पे पता नहीं funding मिलेगी नहीं मिलेगी, कैसे काम चलाएंगे. So these ifs and buts are generally there with most of the developers which we're talking about today. Great. I'll come back to you for your next question there. So my next question to here is Mr. Pankaj Sharma again. So Pankaj ji, is private credit attracting a different type of developers today than it did 5 years ago? And how has the borrower's profile evolved?
Okay. See, there has been quite a considerable change in the borrower profile, and this change is typically not about the size of the developer. I think this change is majorly towards the character of the developer, the governance, the transparency, the documentation quality, and the skin in the game of the developer. So if you try and compare from say 5 years ago, developers typically used to come to private credits because banks would not lend, right? Because NBFC liquidity was typically dried up post the IL&FS debacle, and because the real estate players also needed to fund their cost overruns, right, on the stalled projects which were there for them typically. Lenders typically charged around 18 to 22% for those genuine distressed capital, and borrowers accepted it because there was no alternative. Now there is a structural shift, right? So private credit typically it's not a market of last resort for the real estate developers. It's becoming an increasingly preferred channel for capital because banks structurally cannot provide. So banks cannot lend for land acquisition. Banks can't fund promoter contributions, and banks are also restricted from construction stage exposure at times in many of the configurations that we have seen. And these are not temporary gaps. These are permanent.
Regular. Yeah,
They're permanent regulatory gaps which are there, and
absolutely. You
that is where
can't
I think
bifurcate them.
yes, and that's where I think private credit is typically designed to fill those gaps. And one of the single most change which is there in the borrower profile is about the promoter equity contribution standard. So earlier and now, so developers now typically contribute around 25 to 30% of the project cost as their own equity, and it's substantially up from maybe say 10 to 15%, which was a decade ago from now. So this is not cosmetic, So once I think a promoter is putting 25 to 30% of the project cost on the table before accessing the external capital, the alignment of your interest entirely changes, right? You pick up some stats of say last year, CY 2025, and try and see that how this is impacted. There have been new launches of around 4 lakh units that we saw in last calendar year 2025. I'm talking about calendar year here. And this was a like 2% year-on-year growth, right? Not a large one. And this was deliberately tempered. It's not a market in distress. So many developers decided to postpone or phase out the launches to maintain the absorption stability and to ensure the pricing visibility. So this is a rational credit positive behavior, exactly which one wants to see in a market which is showing signs of some bit of moderation, right? You pick up data of the top 7 cities, right? Last year, the sales volume typically declined to 14% year-on-year basis, right?
Yep.
But the total transaction value, right, that crossed around 6 lakhs crore, which is up by 6% because buyers gravitated towards the larger units over here, right? And superior amenities and premium locations, right? So the developers who are typically benefiting from private credit in this environment are the ones who have read this premiumization trend correctly, and they have positioned their inventory typically according to how this market dynamics are changing. The impact is majorly some bit on the mid-income and the affordable segment developers because they have faced demand constraints from the elevated borrowing cost which has happened. Right? So, in nutshell, I think the private credit today is supporting a deeper structural trend, which is market consolidation around platform developers. So, the borrowers who approach a private credit fund today, and if they come and they arrive typically with audited balance sheet, track record of the RERA compliant project completions, at times the credit ratings, and there is an increasingly they have a market aspiration also that they want to go to public and be there as a listed company, right? So in last 5 years, we have typically seen that 40 real estate IPOs cumulative were raised around say $500 billion of 500 billion rupees of amount, and last year itself 2025 contributed to around 180 billion out of this, which is like a 30% rise. So, in nutshell, I think this private credit has become a stepping stone on the journey of the developer towards public market credibility, and it's not a fallback when you say the public markets are closed. So, I think this is one change we have seen in the entire behavior of the borrowers over a few years.
True. So I think very well said. One is not the size; it's a character of the developer that has been changing right now. Where these guys are more got serious about legal compliances after RERA coming in, and that's a big shift in the sector also. And yes, I think I totally agree. जो हम promoter contribution की बात करते हैं, where it used to be hardly 10-12% that point of time, has increased to 25%, and that gives a lot of comfort to the investor कि ठीक है promoter की skin in the game है कि land के खर्चे के अलावा अगर वो construction में भी 20-25% अपना contribute कर रहा है, so that's one major comfort to any investor that you're talking about. The only thing that I feel is a little concern area in last 4-5 years what has happened is on the affordable housing side.
Yeah.
So there were so many big projects, developers who had gone into affordable housing, doing genuine work, frankly speaking, very good work that these guys were doing, have dropped out from there. For the simple reason, they say, कि भैया ना हमें land सस्ता मिलता है, ना हम लोगों को कुछ और benefits आप लोग दे रहे हो. So how do we manage? कि मतलब everywhere that you're talking about, the expenses are increasing, the construction cost is increasing, we're getting the land at the same rate. So why do and how do we manage affordable then? We are not able to do affordable housing because we are not able to manage the costing part of it, what you are expecting out of us. So I think that is something which is a little concern area, which is needs to be taken up with the government. How do you think we can support affordable housing right now? Because without naming the developer, there were 4-5 large developers who were aggressively doing affordable, have all moved to mid and large, saying कि बस we're done. Till the time, now we get some changes in the regulatory side, we can't support affordable further.
Right.
So that's the only concern area I have in the segment. Otherwise, I think rest of the things, the market has been doing pretty well as such. Great. Thank you so much, Pankaj ji. So my next question is to Prateek Tibrewal ji. Prateek ji, as underwriting becomes more selective, what changes are developers making in governance and lender communications before seeking institutional capital? I think very important because अभी अगर हम बोले governance और lender communication के हिसाब से it's really changed a lot in last 4-5 years when you're talking about. What are your thoughts on it?
So today, as I was saying in my previous answer as well, what's happened is the relationship is today, not transaction oriented. So you end up spending a couple of years, it could be even a decade, in terms of knowing each other. And that's where the comfort is coming in. And what is key is the entire transparency and communication. So there's a continuous dialogue. It's not a transaction. Today the intent of being in regular touch with large investors, whether it's private credit, whether private equity, whether banks. Today, it's less about transaction. It's more about building a comfort and, the entire, familiarity and getting comfort. So what happens is, communication channels today are very, very transparent. You keep each other apprised of new developments, what's happening, what are your growth plans, what each organization is looking at. And the intent is to, again, lot of interactions at the senior leadership level, at the promoters level, is to get comfort with each other, the ethos, the entire corporate governance standard, and then the quality of disclosures. Today, lenders are willing to talk about special situations, they're willing to talk about distressed deals, they're willing to talk about any and every sort of situation which may not be addressed in the conventional source. What they require is transparency. They don't want unexpected shocks, and what they want is you are being completely transparent to them. So for example, when we have done large diligences, often to the extent of $300 million single, yesterday I was speaking to one of our big four partners who was just doing a diligence. He mentioned, Prateek, there is zero red flag. We've been able to complete in 15 days. The team exactly knows what to give, and they have provided us in an apt manner, and that's the reason I didn't contact you for 15 days, and we are wrapping up the process and we'll be in touch with you if any information is required. So that's what's changed, the quality of disclosure. So today, what lenders really rely on, what was the quality of information shared at the first hand itself. When they see that what was shared, and the diligence is always confirmatory. It's never overarching. So the idea of this diligence is very clear. They want to be sure, or they rely on the partner. When this kind of transparency comes in and the quality of disclosures come in, the lender's confidence is very, very high.
Very true.
this helps the underwriting. And again, underwriting standards today have changed. It's more cash flow driven. It's less about predicting about what the speculation would be. Like, for example, 10 years back, price escalation was a very, very normal thing in the model. 5%, 10%. What is the escalation that you want to assume in the project life cycle? Today, lenders don't talk about it, developers don't talk about it, because it's very simple. That is something that's icing on the cake, will ride the market together, and it's a private credit deal, right? So whatever you end up selling, that's a benefit which goes to the developer. You are very, very pragmatic. Today, whether your construction cost, whether your contingency measures, everything has become rock solid. Contracts today are open. These are large contracts, so either it's an item based contract, fixed rate contracts. Your quality of management, supervision is very different. You have third party PMCs on ground, you have developers PMC, you have lenders or investors PMC. So everything is getting monitored. So the underwriting today has transformed. Even if you look at sales quality, cash flow, everything is completely transparent. Your data today, whether a investor is funded you or not, they are tracking your data. They understand where you're stacking, how your projects are getting delivered. They like, for example, imagine the kind of transparency which has come in. We upload all our construction videos every month for every project online on YouTube. It's
Wow,
open for any and all.
fantastic.
So none of our home buyers need to go to our site. Anybody in the world can simply log on to YouTube, type the name of the project, and they'll be able to see month on month construction videos, month on month. So that is
That's
the level of
fantastic.
yeah, so that is the level of transparency and underwriting that we are talking about. Today it's all about communication, whether it's with home buyers, whether it's with your regulators, whether it's with your contractors, whether it's with your investors. I think communication and transparency is the most important. The quality of disclosure. So I think
Mhm.
the more and I think that's the clear differentiation between why the larger top 10 developers market share is continuously growing. They are defying all the slowdown in the market. You look at any market, the top 10 developers today have only talking about GDP launched, right?
Hmm.
Because their fear is they will not be able to bring in the supply in the midterm and the long term, because land acquisition has become a challenge. Now, what does this show? That people who are delivering are consistently. You look at the quality of investor presentation today. You pick up any of the
Hmm.
top five,
True.
seven developers. You look at large unlisted developers like ourselves. The quality of information which is being presented today, the length and breadth of the information, I think that's beyond what it used to be decade. So that's why the decisions are far more informed, whether for the investors,
Hmm.
whether for the home buyers. Today, a home buyer is as demanding in terms of information. They want to have a complete check on the developer's profile, credibility, track record, and why not? I mean, they are trusting the developer with their life savings, so why not? So I think if you ask us, underwriting standards have changed, and I think the developer community itself has played a big role in bringing around that transparency and bringing confidence back, whether of the buyers, whether of the stock markets, whether of the institutional investors.
Perfect. No, I think, one more change which I see because of this underwriting and the transparency is now you have only the actual people who are working on the ground. Is it pehle tha, कि probably anybody comes up on the basis of some land from the authority, start working on the projects. They are still at a naksha stage, nothing happening, and the home buyers have already put in money, gone blank about karna kya hai. There is no movement in the project. But now I think, after RERA coming in, after there's underwriting improvements coming in, or the transparency, governance, communication, which is led by all you guys who are there as a cream there in the market right now. I think you guys have set a standard for others also to follow. And now it's clear, कि अगर आप ट्रांसपेरेंसी के साथ काम कर सकते हो तभी आप मार्केट में सस्टेन कर सकते हो, and only then you can probably raise money in the market. Otherwise, there is nobody probably ready to put in money, be it investor or be it even the end user. Today, like you said, end users are also very educated. So even today, if he has to put in money, he will do multiple site visits,
Yes.
take multiple feedbacks before he puts in money there. So I think that's a drastic change which I have seen in the market in last 7-8 years that I talk about. Thank you so much, Prateek ji. So I'll go to Sandeep again for my next question. Sandeep, following RBI's February 2026 ECB liberalization, like I was discussing, how do you expect offshore private credit to impact real estate financing over the next few years? And are these segments of real estate market that are now becoming financeable via ECB?
Okay. Just to go back to what ECB actually stood for a couple of decades back, a decade back.
Right.
So external commercial borrowings were limited to very large corporates with eligibility certifications from financial regulatory authorities in this country.
And
Only
not
they
for
were
real estate
permitted.
at all. Real
No,
estate
no,
में
no, no,
किसी
not for
जगह
real
कभी हुआ
estate.
भी नहीं है.
No, only for corporate sector borrowers and majorly for manufacturers of, again, certified, eligible by the authorities over here. Only they were allowed to access foreign funding, which was majorly through banks or other kind of financial institutions, and recognized. Again, those had to be on the list of the recognized lender list. So there was a fixed lender base. Say 500,000, 1,200, entities which were allowed to finance Indian conglomerates, and those conglomerates were limited to a list of few hundreds again. Real estate was at of course, the bottom of that list. Real estate was not allowed to access ECBs in real sense when ECB was only ECB. So when we talk about real estate and ECB right now, the entire scenario has changed. The market is not limited to ECB. In fact, I don't think real estate players are also very interested in ECBs, because there is another route where we get better financing inside the country through foreign currency AIFs and foreign currency funds. And Gift City has made money coming in India almost very smooth for external investors. And when external banks and when only external banks, were financing the top conglomerates in the country, it was a different scenario. Today, any individual sitting in any part of the world could invest in an Indian AIF, funding Indian real estate or Indian opportunities, and could be just a retail investor from any part of the world again. So the money being accessed right now is from pooled funds, not from a financial institution. These pool funds are being governed by Indian entities, and the Indian entities decide who would be able or eligible to take those funds. So taking government out from the ECB equation and taking offshore private credit as the as the correct system for real estate. I mean, the entire landscape has changed. ECB is not something that we really care about right now, at least from the real estate point of view, I'm saying. And earlier as well, when we're talking about, as Prateek was saying, so I mean, between you and Prateek, what conversation you were having, why 10 or 15 or 20 top developers of the country are growing market share every year on year? That was because those were the first eligible real estate players who were permitted to access international funding, from financial institutions. They had the permissions, the earliest permissions. We don't need to take the names. We all know who the top 10, 15, 20 developers are. But then now the market has changed. The moment you ask how it has changed, then let's go back to the conversation you were having with Ankit. So Ankit said, right, tier 2 markets are looking very, very attractive. ECBs were something which were not, in any way accessible to any large player from any part of the country other than the top 6 metros. Okay.
Absolutely.
Now any tier 2 city player with the right kind of balance sheet, with correct corporate governance, and with the right kind of regulatory compliances, and with the right kind of communication with all the stakeholders in the market, can access money from anywhere, sitting anywhere, for a project being implemented anywhere. So I think it is, the liberalization of ECBs or the liberalization of private credit in the private fund market is something which has enabled private developers across the country to take wings. Now, a developer from Indore or Bhubaneswar or Mysore or Lucknow can access foreign currency money, and people like Ankit or other large fund houses who are doing the foreign currency AIFs can decide here, whether they can fund those companies or those projects or not. So from a large corporate balance sheet, private credit has come down to fundable assets, asset-backed opportunities, individual projects. So I think that's a major shift, the most important shift. Also, I mean, in terms of regulatory, loosening up. So liberalization was more about expanding the, fundable base was as well, also the funding base. So the lender list was enlarged pretty much. Eligibility criteria went out. A lot of new corporates from everywhere across the country can access ECBs now. 750 million USD was the earlier annual limit for even the largest of players. Now there is no such limit. 300% of your net worth is what you can access. So it makes a huge change for the players who sit in those categories, who were eligible who were in the terms of market size eligible for larger funding, but Indian government or Indian regulations didn't allow them. Now they can, borrow to whatever limit they want to, up to 300% of their net worth. Also, what I see is the most important thing is what I believe is the AIFs, or the foreign currency funds which are investing in India, be it equity or be it private credit. The yield that we deliver, the yield that Indian assets deliver from real estate perspective are far higher, far greater than the developed markets. So as Ankit said, I see a very, very strong future for incoming money into real estate development, specifically for real estate, and not through ECBs, but through offshore private credit. Yeah, because our yields are way higher than developed markets. So money should flow. It should start flowing in big quantities and big numbers. It has already flown, but then through private sponsors and private executors, foreign executors. So, say for example, Horizon Industrial Parks. It is sponsored by Blackstone, owned by Blackstone, operated by Blackstone. So that is a different story, where there is an investor-operator model. The investors have gotten the money themselves, have set up the platform themselves, and executed the strategy themselves. What I see further is the investor getting in the money, we allocating the money, and somebody else running the show, an Indian running the show. I think that's about to happen. Yeah.
Great. No, I think very well answered. So it's more about different structures which can be explored or worked on right now, with the better reach to funding, be it in the form
Yes.
of equities or the offshore fundings that we're talking about. So the accessibility has improved, the limits have improved, the yields have improved there. I think that's the requirement for any developer's perspective that we're talking about today. And I think that's the next segment which we can look at. And
It
I
has
think
set a stage for further maturity, of course. The maturity will come. It is just the beginning. Yeah.
So I think this is just the beginning, and there are a lot of other opportunities which we can look at. The only thing is, I feel right now is that the public market, the IPOs and stuff that we're talking about right now, which was restricted basically, to major tier 1, 2, 3, tier 1 or 2 cities right now, probably, would have more developers now going into IPOs, even from tier 2, tier 3 cities also. Because the accessibility will improve, the listing again, would become easier for them, the valuations and everything would be better access. So I think that should be the next change which I can look at, that probably, more of tier 2 developers, if these guys can take out the IPO route or the public market route.
I believe so. Yeah.
The positive sign of that. Great. So you were saying something, Sandeep?
That's all. Thank you.
So my last question would go to Ankitji, and then we have a couple of questions from the audience. I can take it up with you guys. So Ankitji, do you expect an increasing share of private credit deals to be refinanced into bank and corporate bond market over the next couple of years?
100%. I think that is a very natural progression of where things will move. Invariably, the capital raised from private credit funds are of a higher cost.
Absolutely.
It ranges from 12% to 20%. Now, beyond a point, even we believe, now we keep telling our borrowers that, the faster you refinance us out, the better it is for you. And we prefer to take money even if somebody comes and prepays us. We take it without charging, or at least with an intent of giving them a discount on the prepayment charges. Now, the reason why we believe that will continue to happen is because I think somebody, the Sandeep or someone else, who probably explained how, at what stage the banks actually come and fund some of these projects. They come at a stage when a project is, say, 30-40% complete, or things are looking better. And we as private credit investors are investing at a stage where the risk is slightly high, and we are trying to take that project to a stage where a bank becomes more comfortable to fund that project. So because we come at an early stage of a project where the risk is high, with a certain milestones to be achieved, and once the project crosses that stage is when a bank can actually come and fund it. So it is very natural, I would say natural evolution for a borrower to refinance this debt from a particular bank or even the corporate bond market. Corporate bond market, though in India, is still very shallow. There is still a lot has to happen. Yeah, but just to compare what is in the US today, if you would see, the large corporate lending actually is done by private credit funds in comparison to banks. In India, however, it has been the other way around, where banks have been doing corporate lending, albeit that banks have not been able to take that segment, which comes with slightly higher risk, and banks have played safe. Naturally so, because they play with public's money. So it naturally makes sense as well. We have seen enough and more NPAs on the corporate side in the banks over the last 10 years. We have seen enough mergers amongst the banking system, which have taken place, trying to solve some of the problems, which is why some of these businesses is coming to us, and that's how it is to move. So a borrower should first come to us and then go to a bank. And if that is not happening, to be honest with you, if that doesn't happen, for instance, if a refinance has to happen with another private credit fund, then something is wrong, right? So this is something where even people are saying that there is an element of risk in private credit, and we tend to agree. So, which is why only if private credit money has been refinanced by a bank means that everything is right and things have moved in the right direction. If that does not happen, something has gone wrong. So
then there's a challenge in the project.
Absolutely. I mean, if he is continuously raising money at a higher cost, that means something is wrong. Now, maybe at times things get stuck and one has to refinance out the older guy with a newer one. Fine. I mean, some of those things will also happen. But beyond a point, everything ultimately will go to a bank, which is where there will be enough and more credit pools which will come from AIFs to banks. So I hope I have answered your question, that this is a very, very natural evolution. And this should happen. This must happen. And if it doesn't happen, means something is wrong.
Absolutely. Ankit, just out of curiosity, wanted to understand. So generally, when you guys come in at the land stage or the early stages of the project, so what is your tenure? So मतलब generally 1 से 1.5 साल का होता है कि आपको लगता है कि ठीक है 1 से 1.5 साल के अंदर लैंड का अगर हम लोगों ने सॉर्ट आउट कर लिया, लाइसेंस आ गया, अप्रूवल आ गया, रेड़ा आ गया, then the advance round starts coming in. So that's a time when probably a new investor has to come in. So generally that's a time frame you talk about?
So we generally tend to give them slightly more time. So look how this starts from. How we think is how our fund lives are structured. Generally, in general, a private credit fund would, by and large, should have, in my opinion, a life of 5 to 6 years. with some extensions. Because
Okay.
our investors also expect money back in a certain period of time.
Hmm.
So we keep some buffer for extension of our fund lives, and we keep at least a 4 to 6 year fund life. So, however, we keep some put options after 1.5 to 2 years. We also keep some make wholes for first 1.5 year. So typically, we generally expect our borrowers to repay it to us within 2 years, because within 2 years they should be
Yeah.
able to move to a bank. So you are
Right.
right when you say that, yes, is it 1.5 to 2 years? Yes, but that doesn't mean we don't give some kind of flexibility to our borrowers, that okay, we give you a paper which is 4 year long, because it is his interest to refinance us out, and we know it. So we're not
Correct.
worried about it, that whether we have given them a 4 year paper, because we can give them a 4 year paper, and we know they will refinance us out in 2 years, and it is a very good outcome. So tenors are longer when we go with the borrower, and borrower also expect that, please give us slightly more tenor and probably relax us on the prepayment charges and everything, so that when we come to pay you out from a lower cost of capital, we have the ability to do so. And as a fund, we also keep put options, so that if we have to ask them to repay us and have to force them to repay us, if we start seeing some kind of credit downfall or downgrade or something, we also keep those options. So the option to extend is in both the hands. Option to take money is also in both the hands. So that way, both borrower and lender kind of have a win-win, wherein both of them have options to either for the borrower to prepay, and for a lender like us to take money faster.
Great. Wonderful. Right. Thank you so much, Ankit ji, for your answer here. I think, that's a lot of gaps which could be cleared, because, generally people come and ask about कि अगर land का पैसा लेना भी है, कितना time के लिए चाहिए होगा, how do we refinance that part of it? So I think a lot of structuring gaps could be covered with these kind of structures. So I have 3 questions right now from the audience side. I can probably ask the questions, and then either of you can take it up, and the questions, whoever wants to take it. So first one, that is, please inform what are the safety mechanisms in place for private creditors in real estate. Going with legal delays in India, we need something rock solid assurity about capital safety. This is from the private creditors, where we're talking about the safety mechanism. In case the money that is borrowed is not coming back, so what are the legal delays in India which needs to be taken care? So anybody, either, probably Sandeep ji or Ankit ji can answer this, because अगर आपको लगता है कि हमने पैसा उसमें डाल दिया and अगर पैसा वापस नहीं आता है, what are the legal delays which can be taken care?
Okay, so as Ankit was saying very clearly, AIFs are now allowed to take their investees to the IBC. Okay.
Right.
Which is the most important structural change which has happened in the Indian real estate capital markets per se. We're talking about real estate, let's stick to that. And to to backstop this, what we do is, because it is private credit, the financing is always backed by a good LTV value. There is a good loan to value ratio. There is always security. I mean, all these financings are good security based. They are, assessed and rated by, agencies like CareEdge. And after that, the financing takes place. There are a lot of advisors and rating agencies which help us to rate the assets, to value the assets, and to secure the assets in the right way. And even after that, something goes wrong, then the IBC is the way we go. Ankit can add something here.
No, certainly, I think that is probably the right thing. And IBC also has evolved on the real estate side, because back in the day, when IBC used to be invoked against a real estate company, it used to be for the entire company, which meant that if there's a project which is delayed or has defaulted in comparison to a project which is up and running, both the projects go into the CIRP. However, there have been several amendments which have come in the bankruptcy law, which has allowed to invoke IBC at a project level. And that is also clear. And even for bidders who are only interested in a certain project can come and bid for a particular project and not all the projects. So some of those, and this is, you can say, learnings of running a bankruptcy process against real estate companies, how these have evolved. And kudos to the bankruptcy board who have understood the problems faced by lenders in the real estate ecosystem, and they have come up with better modifications to the law, which has allowed all of these things to happen. So yes, IBC law has given enough teeth for recoveries. Brightly mentioned LTVs, and even RERA has helped a lot over the past few years for one to underwrite and understand how the project is going, because even government RERA has a lot of control over the project movements. So rightly answered, I think probably these are the ways where we have
where you
uh,
can safeguard the
yeah,
private
safeguard.
credit funding.
Correct.
So next question is there. I can read it out, but I don't think this is a real life situation here. So any safety mechanism for private investors to protect their capital being diverted by real estate developers to service debt or repay other investors, especially asking for a small ticket size of 20 crores. So two things here. One, I doubt anybody would probably take a private credit to repay existing investor, because the reason behind the private credit money is an expensive money. तो आप एक्सपेंसिव पैसा लेके अपना वो एग्जिस्टिंग डेट रीपे, मुझे नहीं लग रहा है कोई भी इसमें करेगा उसको. दैट्स अ सेपरेट थिंग. And plus, I think private credit money does not have a restriction on probably, if you can use it for repaying your existing investors or not. I think private credit money can be used for project purpose, as well as for land purpose, as well as for other existing settlement of investors as well, in case there is any such situation. Sandeep ji and Ankit ji, you can correct me on this.
So I think you are 100% right. But from a safeguard mechanism, these days we operate through escrow mechanisms, where all the monies that are routed through proper escrow channels, and the end use of the funds are properly monitored, and even the receivables coming from those projects are now monitored these days. As lenders, we also have control over the escrow accounts. So yes, I mean, some of these things have definitely probably have happened in the past, but I think going forward, the ecosystem has evolved in a manner where we know how to control some of these risks. So we have seen TRA accounts operating, we have seen escrow accounts operating, and we work so closely with the banks that we ourselves have our login passwords to check what's going on, what has come in, what has gone out. So there's enough checks and balances available these days.
Great. But generally आप लोगों ने ऐसा कभी सिचुएशन देखा है कि कोई प्राइवेट क्रेडिट लेके अपने एग्जिस्टिंग डेट को सेटल करेगा?
Yes.
I don't
हो
see
सकता है.
that.
हो सकता है.
Yeah.
Yes, हो सकता है, because at times what happens is, although the existing debt may be at a lower cost, but at times if the principal repayments kick in, if there is a delay, a borrower may think that no, if I just get 6 months, 9 months, I'm borrowing only for a period of 12 months,
Stress
even if
in
it
case
is
of stress
slightly.
credits.
So he obviously chews on to his equity value. His equity value goes down, but it is better than defaulting. So people do that at times when a project probably has some cash flow mismatches. So it can happen. I wouldn't say it won't happen. It can happen.
Great. No, thank you so much. Last question is very interesting one, and I think everybody would look forward to an answer for that. With more transparency and better governance and regulatory framework now visible, do you foresee a situation where the RBI may permit at least part of the bank funding being allowed for land purchase?
I hope RBI doesn't do it because it's a big market for private credit players.
I know. Seriously, we will be out of business.
This is really tough, yeah. Because see, Land is a
It
non-productive
looks tough,
asset.
yes.
Yeah, it's a non-productive asset. It's a
Yes.
pre-revenue asset, right? You can't directly give it to the banks to fund the land acquisition until and unless I think see there could be a partial way to it, and not now, maybe 3, 5, 7 years from now, when probably you can try and put some covenants in terms of that it should be RERA registered, right? And you should have certain LTV caps, some bit of disbursements, some milestone drawdowns, and if at all some credit of a lender allows all these things to happen. But it seems really tough, I think, given the background of how sectors turned out earlier.
No, so
Also,
I think one of the reasons why this is tough, and I agree with Pankaj, one of the reasons why it is also very tough and probably won't happen is because if you allow that, the land prices will start soaring up because anybody and everybody would start borrowing to buy a land because everybody wants to own a piece of land. Even we as retail individuals, when we own a house, people say, if not nothing, go and invest in land. And if capital is available at a cheaper cost to buy land, I think the land prices will soar up a lot, which can also create inflationary pressures on the country. And given that backdrop, I doubt if that thing is going to happen anytime soon.
the intent is very clear. I mean, you don't want speculation, right? That's the
Yeah.
clear intent. You don't want speculation in the land. So I think that's the predominant reason why RBI is not allowing the banking money to go into the land acquisition. And that you also want the sponsor commitment to come in initially, where at the end of the day, you want the equity to take the risk of land acquisition, and only once the risk is reduced, you want the next set of the cheapest capital to come in. So from a risk return perspective also, it doesn't make sense that the highest amount of risk is borne by the cheapest capital in the stack. So I think that's where the misbalance is. It's not about governance, it's not about transparency. It is just about purely avoiding speculative real estate bubbles. I think that's where this policy is stemming from.
Yes, and just to add,
having more skin in the game that we're talking about,
yes.
even from the promoter side, that how much is your skin in the game? Because once you've invested in the land, so that's a big chunk.
See, just to add my two bit, as everybody said, from the speculation point of view, so which is from the economics point of view, and as Prateek again explained, from the economics point of view, it just does not make sense. And then lastly, from the policy standpoint, it makes absolutely no sense because the government or the country is grappling with the problem of affordable housing. Making bank finance available for land will go exactly opposite of that.
True.
Yeah.
That's a major hurdle on that. Great.
Policy part, yeah.
Thank you so much. I think, we are done with the questions part of it. I would like to thank all my eminent speakers for joining this session. And I'm sure, with such detailed discussion on the private credit side, it gives a broader perspective to all the audience about what are the other options which are available. And I'm sure, this will also help them plan the projects well and execute it well. Because when they know that apart from banking, there are other options available also, they will be in a better position to structure the deals better. Thank you so much. Thank you for joining in.
Thank you.
Thank you.
Thank you so much.